These five companies, Adobe, Nike, Uber, Dollar General, and ASML, they aren't just stocks. They are potential value plays. They're the top five stocks out of 1,850 stocks that have been analyzed by our community members inside the Everything Money community this month. I'm going to show you how to find value out of these and determine if they're selling at the right price. Guys, in investing, what we're trying to do is figure out the price we're willing to pay for a company. It's not like a cell phone. With a cell phone, we know the price of this. You just go on the internet, you Google it. If you want to buy this, this is the price. And this is basically the value. You can go on eBay and find the values. That's a lot easier, but that's what we're trying to do with stocks. We're trying to determine what the value is. The difference is the value isn't as in your face. It's about determining what the future growth of the business will be and taking all their cash flows and bring it to today using these tools. That's what we're trying to do with stocks. So let's look at stock number one, Adobe, a stock I currently own. And I was fortunate enough to see it fall to 405, but I didn't pick up any shares at 405, so I want to punch myself in the face. But either way, I currently own it. And remember, no stock should be bought because anybody on the internet has it, or even Warren Buffett has it. You buy it because you understand what you're buying. So Adobe's $193 billion market cap. And look at this, a 201 or 208, depending on the way you calculate it, enterprise value. Guys, this difference is their net debt. So 8 to 15 billion. And look at this cash flow last year, $7.9 billion. They can pay off all that debt in 2 years all day long. And in 1 year, based on how you calculate enterprise value. High returns on capital, which means it's a moat. It means they get a great return on the money that gets invested in the business. Remember, you want to pay a premium to companies that can invest money and really grow that profit. And the other thing I like, they're not paying a dividend. You might sit there and say, well, Paul, we love dividends. Dividends have their place, and I enjoy getting my dividend check too. But I'd prefer to buy companies that can reinvest at higher rates of return to grow that profit more and more. That's how you really take advantage of fast-growing companies. Gross margin here, guys, look at this, 89%. This means that for every dollar they bring in, 89 cents of it will be able to go to the bottom line before taxes and overhead. That's incredible. Because for them to sell $100 million more, they won't have to add any overhead, and they'll just have to pay their taxes. That's 89 cents to be able to pay their taxes with. Absolutely incredible. Great growth rates, phenomenal company. Let's go see the 8 pillars and see what story that's telling us. Well, like all companies I love, high PE, 5-year, high 5-year free cash flow, checks all across the board. Now, you might sit there and say, Paul, these are X's. Why do you own this company? Well, first off, I bought it sub 430, which is great, but basically it's there right now. So these high PEs and free cash flows are still an X. But remember what this, guys, if a company is growing fast, it deserves a premium. That's why I get confused when people say value investing and growth investing are different. No, they're not. They're one and the same. You can find a value play that's a fast grower. I think Adobe's that. They can grow their profit a lot faster than everybody else. They can grow their free cash flow a lot faster than everybody else because of this 89% gross margin. If a company has a 20% gross margin versus a company with 89%, the 89% gross margin, for every dollar they add, they're going to add 4 times more free cash flow than the 20% gross margin business. That's another reason why it deserves a premium. So let's see what analysts are thinking. Do they agree with me on this growth? Well, guys, they estimate $21 a share this year in profit, growing to $35 in the next 4 years. That's 12.5, 11.5, 16.5, 12%, and 15% growth in their earnings per share. And along the way, 10, 11, 12% revenue growth. Now, I've heard people say AI is going to absolutely obliterate Adobe. I disagree. Adobe is still going to be useful for a lot of people. Now, could it affect them? Adobe's going to use AI to make their products better. Adobe's going to use AI to make their products more valuable for the consumer. Now, we're going to get in the story about Adobe. We've already looked at the numbers. The goal is to combine those two things. Once you have the story and the numbers together, you use that to input it into our stock analyzer tool. Our stock analyzer tool is used over 1 million times per year by our users to marry the story and the numbers together to find the right price for you. So, how do we make reasonable growth assumptions for Adobe based on its 2024 performance as a company, not as a stock. Record revenue of $21.5 billion, strong cash flow of over $8 billion, and significant innovation like Firefly's AI integration. Adobe is clearly executing well. But the perception challenge of a 25% stock drop and regulatory hurdles, we have to balance these factors to project sustainable long-term growth. That's what we're trying to do here with Stock Analyzer. So let's see what I did most recently with Adobe Stock Analyzer assumptions, because I can go to my history and pull it up. So I did very reasonable, 6, 8, and 10% revenue growth over the next 10 years. I did profit margin of 26, 29, and 32. Same with free cash flow. I did 38, 40, and 42. Now, remember, that high gross margin could drive this up even higher. But I'm just going to stay conservative and say, let's keep it based on what they've done in the past. Now, PE. They're currently at 35, and 25 for PE and price of free cash flow. I love that their price of free cash flow is lower than their PE. That means they're generating more free cash flow than the net income is showing. Usually it's the other way around, and we have to sit there and go, why is that? So I put 18, 21, and 24. Guess what? With increasing ROIC like this, I won't blame you if you put this higher. I'm just sitting there saying, okay, let me be conservative here, and I put my 9% desired return. And I do that in all of our stocks because I want to find my intrinsic value. What's the value of the company if I get my 9 or 10% market return? But remember, you need to put a margin of safety in. You need to have a higher desired return because the future is unknown and we're humans and we make mistakes. So what's my value? The stock's currently trading at $436. I have a low price of $396 based on free cash flow, high price of $730, middle price of $540. So I'm looking at this saying, hey, there's a lot of value here for this company potentially. The question is, what do you think about their future? Stock number 2, Nike, a company I also own that's been struggling lately, but I want to keep in mind for everybody. A few years ago when Nike was at 180, we made videos saying, we're probably interested under 100. People said to us, Nike will never be under 100. And I say this in every freaking Nike video. I have to. Just as a reminder that stocks are going to go up and down like crazy. Look at Netflix. They just reported, and they were at $160 a share just 2.5 years ago. Now they're at $1,000 per share. That is 6x growth in the last 2.5 years. After falling from 700 to 160 back up to 1,000. Nike has a $110 billion market cap, high returns on capital here, and getting better. A dividend. $2.24 billion of their $5.5 billion last year was eaten up in dividends. That's a lot. It's 2% dividend yield, but it's not over 50% of the 5-year free cash flow. I personally like to look at that. Doesn't mean it's a set in stone rule, but I want my dividends to be under the 5-year free cash flow average, 45% gross margin. And guys, I think that's going to get better as they do more direct to consumer selling. So what's the 8-pillar story? Oh, wow. Look at this. So guys, apart from the 5-year free cash flow, and one could argue this is a reasonable free cash flow for the company. Why? Because they're Nike, high moat. They're selling for 20 times price of free cash flow, 22 times earnings. Why? Because their free cash flow in the last year is greater than their net income, $5.5 billion versus $4.9 billion. Buying back some shares, and I like that they're doing that as the stock falls. So, what are analysts saying about the company? A lot of people say this company is dying. 281 for this year for EPS, growing to 636 in the next 4 years, 5 years. And they're analysts. You have to sit there and factor that in there. And then revenue growth, they actually have a almost 8% dip this year, and then back to reasonable growth levels. I mean, one fluke year of 18%, but there's also a lot less analysts projecting that. So maybe 4, 5, 6% revenue growth along the way. So again, with Stock Analyzer tool, how can we make realistic assumptions for Nike based on both its dominance and the challenges being put together? They have 24% global market share in athletic footwear. Innovative efforts like Move to Zero sustainability campaign, and booming digital sales through their SNKRS, their sneakers, and Nike Direct. Nike's growth story is still compelling in my opinion. But labor practice concerns that have been going on for decades, supply chain problems and vulnerabilities because of what's going on overseas, and of course, the geopolitical risks can impact the company's ability to sustain that profitability and deliver long-term shareholder value. Guys, there is so much great stuff with almost every company that we talk about. The question is, how do you balance the good news with the bad news? When the stock is dropping, people gravitate towards the bad news. When the stock is going up, people gravitate towards the good news. They're both still there, and in all likelihood, staying there. Because not many companies are going to be the Enrons of the world and the Tycos of the world. For those of you who don't even remember that, those are the companies that were basically all fraud, right? So we have to sit there and balance that all together. So let's go look at my stock analyzer assumptions and some of the ones. And I love the fact that our community is looking at Nike, because my personal opinion is when I look at a company, I want to sit there and find a company that is a great brand, going to be around for a very long period of time, but might be going through a short-term perception issue or real issue, but that I can see 20, 30 years from now being a lot bigger than it is today and paying a good price for it today to justify the investment. So I made assumptions for the next 10 years of 3, 5, and 7% revenue growth. Very reasonable. I don't think anybody would sit there and say, oh, that's crazy high or even crazy low. Profit margin, 10, 11, and 12. Same with free cash flow. And a PE of 20, 23, and 26. Remember, you got to pay a premium for Nike. If you're not paying a premium for Nike, what the hell are we doing here? Finally, 9% desired return. Hit the analyze button. My intrinsic values are 60 all the way to 120, 85 in the middle. If I paid today's price of 74, I can expect a discounted cash flow return of 10.75%. And guess what? That also includes the dividend. So you don't add the dividend on top of this. It includes that dividend. Stock number 3, Uber. The thing I love about Uber, guys, is a few years ago when the market went through a little bear market there, I know we don't even know what a bear market looks like. The CEO came out and said, listen, the market's changed. We need to focus on cash flow. And they've done a great job of doing that. Here's proof. Their 5-year average free cash flow is $570 million. Last year was almost $6 billion. And that has actually skyrocketed their returns on invested capital from the negative to the positive. Guys, Uber dominates this market. It's over 70% market share. If you watch the show, they said if people use Uber twice, they were hooked on it for life. Uber is wonderful. It's great. Does it have its issues like safety concerns? Of course they do. Whenever you get a company like this that's changing markets like that, it's going to be an issue. You have to sit there and look past the noise. Amazing revenue growth, 28% a year for the last 5 years, 41% a year for the last 3 years. Major revenue growth here. So let's see what the 8 pillars. My guess is it's ugly, and guess what, guys? It's ugly. All X's except for revenue growth, net income growth, and cash flow growth. Shares outstanding increased 23%. Now remember, the high PE and the high price of free cash flow for the last 5 years, ignore. I mean, why do we even care about this? They're growing their cash flow. This was not a cash flowing business to start, but now that they're doing it, they're doing a great job. And they're selling for currently 24 times last year's free cash flow. Now, that's pretty awesome if you ask me. I look at the 8 pillars going, this is useless. The 8 pillars here are useless because you're looking at a company that's just going from negative cash flow for growth to positive cash flow. I'm going to take a deeper look into their income statement. I mean, look at this revenue growth. 13, dropped to 11 because of COVID, 17 and a half, 32, 37, and in the last 12 months, they've done $42 billion. That's a lot of growth there. Let's look at their net income. Negative 8.5, negative 7, negative 500, negative 9, 1.9, $4.4 billion in profit in the last year. They are focusing on profit now. Now, the one thing I do want to look at these shares outstanding. It is growing. It seems to be at a decreasing rate, but it's still growing there. I'm like, guys, just pump the brakes here. You have the cash flow. What's the need? It's probably from stock options, things like that. But these are the things you have to factor in when looking at this company. They've increased the number of shares by 23%. That means that you have 23% more partners if you own the company 5 years ago versus today. Yes, you're still seeing amazing growth, but it's dilution. It's giving you less ownership of the free cash flow, the revenue, the profit, etc. So just remember that and factor it into your analysis. Factor that into your margin of safety. So let's see what analysts are saying about this company. EPS 241. I'm surprised they only go out 2 years, 3 more years. 241, 347, 550. Big time growth there. And then revenue, 15%, 16%, 8%, 13%, going from 51.7 billion to 73.7. Guys, Lyft is a competitor. Of course. But Uber's got operations in 70 countries, 28 million trips per day, and the first ever net income of 1.9 billion in 2023. Their potential is clear and evident. Now they're diversifying into Uber Eats, freight, and a $1 billion advertising run rate shows how they're adapting to the markets. However, these margins aren't the greatest, and looming regulatory risk around driver classifications, you've got to be able to weigh that in on their impressive reach across and against their costs and the challenges. But guess what? They've had nothing but challenges since day one, and they've done a great job overcoming it. Let's look at these margins. I want to show you these things. From a gross profit perspective, not bad, 40%. And look at this. Last year's profit, 10.5% overall from the bottom line. So these are things that are positives. Do I think the hurdles are there? Of course, there's still hurdles. Do I think the hurdles of, is this business going to exist? Probably not a big hurdle anymore, but could happen. I look at this going, man, what would have to happen that Uber's gone in 10 years? Well, Waymo could kill it and be like, hey, listen, we're driverless. You have to worry about risks with the driver. You don't have to worry about all these, but guess what? I'm sure Uber's going to come up with their own solution. They're already working on that right now. And I'll tell you, I'd love to be able to enter a car where there's nobody driving. I don't have to deal with any of that stuff. So what are our assumptions on the Uber? Pull it up here in my stock analyzer tool. I did 10-year analysis, 6, 10, and 14% revenue growth. Profit margin, 10, 15, and 20. Free cash flow, I kept it exactly the same. PE, 15, 18, and 21. Same with price to free cash flow. And of course, my 9% return. And guys, I'm sure that since they just became profitable, you might have disagreement on these things. Should I make the growth rate lower? I don't know. 10% revenue growth over the next 10 years means they're going to double in 7, and they're going to go up another 35% from there. So they're going to, that's pretty good growth rate, doubling plus a 35%. So they're doing 42 billion, 42 becomes 84, and then 35% of 84 is 30, roughly. So you're at so you got $115 billion in revenue. It's a lot of revenue. Even at a 10% margin, that's a $11.5 billion profit business. 11.5. So we hit the analyze button. Guys, this is pretty interesting. Low price of 37, high price of 172, middle price of 85. Now, it's not on my watch list, but it's going at a 12% return here. I think I'm going to add it to my watch list at $60 a share. It's probably going to be there if the market hits because let's look at the price here. This is something interesting. They were $55 a share just back in August. It's something to pay attention to because Uber is a company that I think they dominate their market, they're growing, and they're generating great free cash flow now. Why do we want to ignore that? We don't. Now, guys, we've only looked at 3 of our 5 companies. These are the things I do every single day. These are the things that the thousands of members in our community do every single day. We made this software originally to analyze stocks, retirement, real estate. As time goes on, we have realized that the demand for the product is very strong. So we want to have good quality, very hyper-focused users in the community. And that's why we now have a wait list. Behind the scenes, we are making changes. We have full-time developers working on this constantly to make sure the software gets better and better. As the years go on, the software will only get better. But as we've grown, it's less about me and more about how I can better serve you, adding more data. We already have stocks around the world, US, Europe, Canada, all over, and we're adding more as time goes on. We're adding economic data now, and this will continue to grow. We are going to update as time goes on. So guys, if you're ready to change the way in which you view investing, before these fully changes get made, join now. You'll be grandfathered in for life because when we make these changes, a lot of these things are going to go away. We're going to take these away into separate categories you have to pay extra for. So if you want to lock that in, $7, 7 days, $1 per day, you'll be grandfathered in for life with everything we have to offer, and you'll be locked in to your pricing tier forever. So click on the link in the description below, get access. I guarantee it's the best decision you'll make this year. It's $1 a day to really change the way in which you look at investing and to give you the peace of mind when you do analyze all these stocks in real estate. Stock number 4, Dollar General. Guys, Dollar General is interesting because they have a ton of stores. They're growing a ton of stores. Their stock is down a ton from its all-time high of 262. It is now at its low was just 5 days ago, it's $66 per share. It's currently at $71 per share. Look at this plummet. Big dividend, 3.3%, and it only eats up about a third of its free cash flow the last 5 years. So if you like dividends, boom, you got it. Now, not a high return on invested capital, not a high gross margin, 30%, definitely not a high profit margin between 3 and 6%. But guys, look at this. The price of free cash flow is 9.5. PE is 11.7. The 5-year price of free cash flow is 11. The 5-year PE is 7.4. So this is why it's gathering a lot of attention from our investors. It's down almost 75% from its all-time high, selling for such a low single-digit to low double-digit multiple on free cash flow and earnings. So what do the 8 pillars tell us here? All right, so they got a lot of debt, but these are all their locations. So I'm not as worried about this, but I still want to make sure I'm understanding that it's mostly the leases they have. And the net income has fallen over the last 5 years. But I like the fact their cash flow is up. What I don't like is that $13 billion in revenue growth only led to $60 million in free cash flow growth. How do you have that when your gross margin is 30%? Sit there and understand. So let's see what analysts are saying about the company. Look, analysts are sitting there saying that earnings are going to double from $6 to $12 by 2029, and that revenue is going to grow, 4 to 8% a year. So let's call it 3 to 5 to be conservative. 3 to 5% a year, 3 to 6 maybe, as they grow locations and as costs go up and they increase their costs on their goods. Guys, they have over 20,500 stores. They plan for 730 more this year, and they've mastered rural America. Sales grew 5% in Q3 2024 alone, and cash flow jumped over 52%. That's pretty impressive. They're also doing something called DG delivery that shows they're adapting to deliver goods to people that need them. But here's the problem. Operating profit dropped 25%. Shrink is eating into margins. That's their loss from theft. And the stock is down 44% in 2024 alone. So you got the company's scale and their growth and the innovation they're trying to do, but you got to put that together. That's exactly what we're doing here. Great company. Are they growing too much? Are they not growing enough? They dominate rural America. That is their bread and butter. I own a home on a lake in Texas. It's pretty rural. There are like $5 Generals within a stone's throw of my house. They're actually pretty practical and good for us in the area, but that's what they're trying to dominate. So let's go see the stock analyzer tool and see what we are looking at here for Dollar General. Just type in dollar. Okay, so I went 3, 5, and 7% revenue growth. I did 5.5, 6 1/4, and 7% profit margin. Might need to go a little bit lower here. Let's go with 5, 6, and 7%. Now, the free cash flow is lower than its profit margin, but over long periods of time, it should equate out. We'll go 4.5, 5.5, 6.5, because I'm sure it has a lot to do with the fact that they are growing their stores and spending a lot of money on capital improvements. PE and price of free cash flow. I went conservative and put 13, 15, and 17 here, mostly because of this declining ROIC, 11.5, 10.5, 7.5% ROIC. That's the main reason I did that. Is it too conservative? Maybe so. Am I attaching myself to this low PE and low price of free cash flow? Perhaps. I did my 9% return, hit the analyze button. Now this is why it's interesting. 115 to 130 on the low side, 260 to 280 on the high side, 180 to 200 in the middle. Is the juice worth the squeeze? It might be. This is probably so far the most interesting proposal, and that's why the stock analyzer tool is so useful. I would have never guessed these would be the numbers for the company, but that's what this tool does. It gives us the discounted cash flow model of doing this. Guys, stock number 5, ASML. They're in the semiconductor business, all-time high. On July 11th of last year, 11.10, 52-week low. Remember 20th. Guys, that's a 40-some% drop in a matter of, 4 months? 4 months. That's a big drop. This company is a $300 billion market cap. I'm actually surprised by this. So this is what I don't like off the bat. Net income, $7.2 billion. 5-year average net income, $6 billion. Free cash flow, $3 billion. 5-year free cash flow, 5.66. So their 1 year is very off. Their 5 years a lot closer. And if you take out this one fluke difference of a year, it's probably even closer than that. But guys, the price to free cash flow of 103, the PE of 42. I'm going to assume this 1 year free cash flow is some sort of crazy, because it was very consistent for a long time, and then all of a sudden flew off the handle. But 42 times earnings for a market cap of 306 billion. I better see a lot of growth there. There's a lot of natural growth. 51% gross margin. Look at this high profit margin, 26%. And they pay an adorable dividend of 0.83%. But guys, it eats up $2.5 billion of their free cash flow. That's a lot. That's a whole lot. All right, so let's see what the 8 pillars show us. All right, what we like to see, a lot of check marks. These shares outstanding, they're buying back shares on, maybe it's a little pricey, 50 times 5-year, 54 times 5-year free cash flow. So revenue growth of 16 billion led to 4.9 billion in net income and 2.4 billion in more cash flow. Big difference there. Look at this return on invested capital, 20.6%, and last year was 24.5%. So maybe it's on an upswing. Let's see what analysts are saying here. 25.78 per share in profit, growing to 51.73 in the next 3 years. That is doubling in 3 years. That's big time growth. And revenue, look at this, 16.5, 13.5, 25, 13.5, 34.5 billion to 55.5 billion. They had 7.5 billion in Q3 2024 sales with 50.8% gross margins and strong demand for EUV systems. This allows them to stay as a semiconductor powerhouse. But they have a 2025 sales downgrade. These geopolitical wins we talk about with Dutch export controls and volatility in some of the markets raise these questions. And semiconductors is a volatile market now. Remember, these pressures and these issues, are they short-term or are they long-term? That's what we're always trying to figure out. That's why investing is difficult. So our stock analyzer tool. Guys, 10-year analysis. I did 5, 8, and 11% revenue growth. 22, 24, 26 for both free cash flow and profit margin, because historically in the last 5 years, they've been the same. Last 10 years, a little bit of a difference. Last year, for sure. PE, 15, 18, and 21, 9% return. And guys, remember, this all makes your life easier. Go to the link in the description below to sign up. Hit the analyze button. Low price of 270, high price of 630, middle price of 416. So this doesn't make much sense to me. Guys, if you want to look at the 5 stocks I'm buying in 2025, watch this next video. Thank you for your time.